Welcome back to the Deep Dive. Today we are jumping straight into what is a really critical moment for India's economic policy.
We're talking about the Reserve Bank of India's December 2025 Monetary Policy Committee meeting.
And this is not, just another run-of-the-mill rate decision.
No, not at all.
This particular meeting has presented the MPC with a truly bizarre dilemma.
It's the very definition of conflicting data. I mean, on one hand, you have the economy just roaring, posting these stellar growth numbers that, frankly, defy expectations.
Right.
But then on the other hand, you have these critical sectors that are stalling, export demand collapsing, and headline inflation is tracking so close to zero, it really raises serious questions about underlying demand.
That contradiction is exactly what we need to cut through. So we've looked at analysis from key institutions like Bank of Baroda and ICICI Bank. Our mission today is to figure out how the MPC could possibly balance these two opposing forces. So let's set the stage. What's the consensus prediction?
The immediate consensus is a hold.
A hold. Okay.
Yeah, the MPC is highly, highly likely to keep the policy rate, so the repo rate, steady at 550%. And they'll probably maintain that neutral stance for the second meeting in a row.
So a pause then.
Yeah.
But here's the hook, the thing that makes this so fascinating. India has booked this incredible run of GDP growth.
Right.
But at the same time, industrial activity has slumped to a 15-month low, and headline CPI inflation has eased to a series low of, 0.25%?
This huge disconnect.
How can an economy be simultaneously overheating and, flirting with deflation? All right, so let's start with the spectacular side of things, the case against cutting rates.
Yeah, the growth story.
It's hard to ignore growth when India's Q2 FY26 GDP clocks in at a staggering 8.2%.
I mean, that's a figure that would make almost any developed economy just green with envy.
For sure.
And that 8.2%, it was a genuine shock to the system. It blew past the RBI's own internal forecast of 7.2%.
So when you look at the first half of the fiscal year,
for H1, yeah, GDP growth stands at a rock-solid 8.0%. It's massive momentum, and you just cannot cut rates into that kind of strength.
And that strength has triggered revisions across the board, right?
Precisely. The RBI itself is expected to revise its annual growth forecasts up from the current 6.8%. And, institutions like ICICI Bank, they've already raised their full-year FY26 projection to 7.5%.
So the momentum is just undeniable.
It really is.
So where is this strength coming from? Is it like all government spending?
No, it's actually pretty broad-based and domestic. We're finally seeing a consumption revival really take hold.
Okay.
Urban demand is strong. You can see it in higher non-gold imports and really healthy passenger vehicle sales.
And what about rural demand?
Crucially, rural demand is also resilient. It's being supported by good rainfall and higher MSPs. That's the minimum support prices.
Right, the guaranteed rates for farmers.
Exactly. It boosts rural income. And we see that reflected in this really noticeable uptick in sales of two-wheelers and tractors.
And the investment side seems to be kind of following suit.
Yes. Private investment is recovering. You can see it in a 10% pickup in credit demand to industries back in October.
And services.
The huge services sector showed really strong growth, 9.3% in the first half of the year. And yes, to your earlier point, the government's CapEx push, the capital expenditure, is definitely working its way through the system.
Right.
Infrastructure and construction goods output grew strongly by 7.1% in October.
Okay, wait, so 8% growth and 0.25% inflation. That just sounds like the economy is sending completely contradictory signals.
It is.
So which signal should the MPC prioritize right now? Should they be worried that this growth will eventually translate into, future overheating?
And that is the absolute core of their dilemma. With 8% H1 growth, the MPC's focus just has to be on preservation and stability.
Right.
They have very little room to start new rate cuts. The priority now is ensuring the transmission, the pass-through of the earlier rate cuts gets into the real economy. If they cut now with such strong growth data, they risk inflating asset bubbles or, creating stability risks down the line. This strong growth actually gives them the luxury of being able to wait and monitor.
Okay, so we've got roaring growth, but inflation is near zero. How do we reconcile that? We have to look at the other side of the ledger.
The other side, yeah.
The sectors where the economy is clearly shrinking or at least stalling out.
And this is the whole argument for easing. I mean, CPI inflation eased dramatically to that series low of 0.25% in October.
Which is just wild.
It is. And this moderation is overwhelmingly because of a sustained decline in food prices. We're talking vegetables, pulses, cereals. It's like a supply shock, but in reverse.
And the forecasts suggest we're going to be far from the RBI's comfort zone for a while.
Oh, indeed. Inflation is expected to undershoot the RBI's targets by a lot. Bank of Baroda is forecasting inflation for the full fiscal year to be somewhere between a very low 2.4 and 2.5%.
Theoretically, that gives them a ton of room to maneuver.
A massive amount of room if they chose to stimulate demand.
But let's get into core inflation. That usually tells the real story about underlying demand pressure. Is that also near zero?
Not quite. And this is where the nuance is really critical. Core inflation is still above 4%, specifically at 4.2.
Okay, so that's a bit stickier.
It is, but the sources suggest that much of this is actually linked to volatility in precious metal prices, especially gold.
So not really demand-driven.
Exactly. If you actually strip out gold and silver, core inflation averaged a much gentler 3.1%. The overall message is still very, very low inflationary pressure across the board.
Okay, let's talk about the specific sectors that are, flashing red. That 0.25% inflation figure, it starts to look less like stability and more like real weakness in some areas,
That's exactly right.
especially industry and exports.
Yes. The Index of Industrial Production, the IIP, its growth just eased so sharply to a 15-month low of only 0.4% in October. That's down from 4.6% in September.
Wow, that's a cliff.
It's a drastic deceleration.
What parts of the industrial sector are dragging us down so hard?
We saw outright contractions in major categories. Electricity output fell 6.9% year-on-year, and mining contracted by 1.8%.
But the real pain is in manufacturing, right? The stuff exposed to the global economy.
That's where it's really hurting.
Can you give us the sort of human context on those export numbers?
Sure. So output of traditional export-oriented sectors just plummeted. Leather goods contracted by a painful 16.4%.
16%.
Yeah, and wearing apparel was down 6.1%. That's just brutal. That's not just a data point. That's thousands of factory jobs that depend on clarity from international trade.
And this is being blamed directly on the U.S. tariffs.
It's attributed directly to the impact of higher U.S. tariffs that are hitting Indian manufacturing hard, yes.
And then connecting that industrial slowdown to the bigger external picture. India's exports overall contracted by 11.8% in October.
Right, and the delay in that critical U.S.-India trade deal, that remains a huge risk just hanging over the whole manufacturing outlook.
This brings us to what I think is the core issue. This entire debate we're having about whether to raise or cut rates, it might actually be irrelevant right now.
How so?
The single biggest takeaway from the analysis we're looking at is that the RBI's main tool, the repo rate, is fundamentally blocked. It's blocked because of a resource crisis within the banking system itself.
That is the key insight. You're right. No matter what the MPC does with the rate, the move is going to get lost in translation unless the banks can solve their immediate resource constraints.
So what's causing this transmission roadblock?
It really boils down to the credit to deposit ratio, the CD ratio. See, credit growth at 11.4% is significantly outstripping deposit growth, which is at 10.2%.
So loans are growing faster than deposits.
Way faster. And that gap means the CD ratio is elevated. It's sitting near 80.3%. So think of it this way. Banks are having trouble raising deposits fast enough to fund their loans.
Meaning they just can't afford to pass on cheaper funding from the RBI. The price for domestic money stays high no matter what the repo rate is.
Exactly right. So if the MPC cuts the repo rate, banks simply lack the domestic funding, the resource pool, to lend any cheaper. The cut gets lost in transmission.
The problem isn't the price of money, it's the availability of money.
Precisely. It's liquidity and deposits. They need to resolve that constraint first.
And this is all being compounded by the strain on the external account. The rupee has depreciated 4.5% year-to-date, driven by weak capital inflows. We've seen significant equity outflows, USD 28 billion since last October?
Huge number. And that weak external account, it forces the RBI to intervene to stabilize the rupee, which usually means selling dollars.
And when the RBI sells dollars?
It sucks up domestic Indian rupee liquidity from the system, which tightens conditions even further for the banks. It's a vicious cycle.
So what is the MPC expected to do to counteract this liquidity strain?
Well, even though system liquidity is technically in surplus right now, about 1.8 lakh crores in November, The pressure from that Forex intervention is constant.
So they need to do something.
To manage this, yeah, the MPC is expected to announce specific liquidity measures. We're anticipating open market operations, OMOs, designed to inject liquidity back into the system to maintain that surplus.
Okay, so given this incredibly complex balancing act, record growth, but terrible transmission and export pain, what is the optimal guidance the MPC can offer the market?
The preferred stance is what we'd call a dovish hold.
Dovish holds.
Yeah. You keep rates steady, but you signal a very clear bias toward easing later. And you couple that with outlining a really supportive liquidity strategy for the next quarter.
So it offers stability, but also a promise of future help.
Exactly. It supports the transmission of the earlier cuts without committing to a new cut cycle prematurely.
You're saying waiting until February 2026 is the prudent call. But, if we see massive job losses in the export sector over the next 3 months because of those tariffs, won't waiting be seen as a policy failure?
That's a critical pushback.
What's the risk of not cutting rates now?
And the MPC is very aware of that risk. But they're holding out for two major factors that should hopefully clarify in the near term. First, they are waiting for certainty on that critical U.S.-India trade deal.
Right.
If a deal is forged, it just changes the outlook for those struggling manufacturing and export sectors instantly.
Okay, and the second reason is much more technical, but I guess hugely impactful.
Yes, it is. The fundamental data itself is about to change.
How so?
Both the CPI for inflation and the GDP computation methodologies are changing. New data series are set for release in February 2026. So the MPC prefers to wait for these fresh, methodologically updated insights before taking any major definitive policy action. They're waiting for the new math, so to speak.
On the external front, though, there is one favorable shift, right? The global environment.
That clicks, yeah. Recent week U.S. economic data, things like soft retail sales, rising unemployment, have increased the odds of a U.S. Federal Reserve rate cut in December.
And lower U.S. rates are hugely significant for India.
Hugely, because they widen the interest rate differential, which makes Indian assets more attractive and could potentially benefit capital flows into India.
Which would help with the rupee depreciation we talked about earlier.
It would help alleviate some of that external strain, yes.
This has been a really insightful deep dive into the high-stakes balancing act the RBI is facing.
It's a tough one.
So to recap, the MPC is anchored by this phenomenal growth, 8% H1 GDP, but at the same time, it's being pulled toward easing by deflationary forces and export stress.
Yeah, characterized by that 0.25% CPI and the abysmal 0.4% IIP growth.
The resulting dovish hold, then, allows necessary time for the earlier cuts to transmit.
And, crucially, for the MPC to get clarity on external risks and, most importantly, on those new data methodologies that are being implemented. They're buying time, really. They're betting that the domestic momentum will hold steady while they wait for the fog to lift.
So since the MPC is actively waiting for these revised GDP and CPI series to be released in February, you should track precisely how this methodological change impacts the perception of the economy. What's the final provocative thought for our listeners?
The final question is this. Will the RBI's new math fundamentally change our perception of the Indian economy? I mean, if the revised numbers created through more sophisticated measurement show that India is actually growing slower than 8%, or that our underlying inflation is stickier than we think, that pause could turn into a definitive rate cut much, much faster than anyone currently expects.
So that change in data perception is the real variable to watch.
It's the variable to watch in the new year, absolutely.
An excellent point. The rules of the economic game are about to change. Thank you for guiding us through this deep dive.
Always a pleasure.